welcome to New Europe Studios. I'm Konstantin Tsapogas from Taube, and with us today is Mrs. Franziska Ohnsorge, who is the lead economist in the World Bank's Development Prospects Group. And she's actually the lead author for the Global Economic Prospects, which is the semi-annual report about worldwide development. Mrs. Ohnsorge, thank you for being with us.
Thank you very much for inviting me.
I was looking in the latest report, which was published a few days ago, and I noticed that you focus a lot on the fall of the price of oil, of energy internationally. Now, and you say that, I'm quoting, that the decline in oil prices reflects a confluence of factors, including several years of upward surprises in oil supply and downward surprises in demand. So what were the surprises? What exactly happened?
It really began, the oil price decline began with the dollar appreciation around end June. But it intensified after the OPEC meeting, where the OPEC decided, instead of keeping the price around 105, to supply a certain quantity. But these are just the immediate triggers of the decline. There have been these long-term trends for the last 3-4 years, where US, or in general, unconventional oil supply has been surprising on the upside year after year. That's the US, the shale oil, but that's also Canadian tar sands, and that's biofuels as well. On the other hand, demand has surprised on the downside repeatedly. And so in our view, supply is the main factor driving the price. On the other hand, there is a large component of weak demand also driving down the price. And why does that matter? It matters because the impact of the oil price decline on global growth depends on exactly that, whether it's supply or demand. And because a lot of it just reflects weak demand, in our view, the impact is not going to support growth as much as one might think based on historical estimates.
Well, actually, weak demand, you mentioned weak demand. We always witness at this time that there is a general trend of diminishing prices in other raw materials, for example, copper. So does this show something, a general trend?
It's actually very interesting. And most commodity prices peaked in early 2011. And other non-oil commodity prices have been steadily declining, gradually. Whereas oil initially stayed flat and then started declining sharply. It was really just the second half of last year. But if you compare the cumulative decline from these peaks to now, oil is not that much of an outlier. It has declined by more than the others, but even metals and mineral prices have on average declined by on the order of 30% since their peaks. Agriculture had a particularly good harvest this year in many commodities, so even agricultural prices have declined by 20 to 30%.
So if it's not a question that's, it's not only a supply question.
Exactly.
It's a demand question. So what is the reason for this diminishing demand?
It's weak global growth. It is just weak global growth that there is, over and over, there have been downward surprises to general demand for commodities. And that is also reflected in our forecast revisions. Essentially, we have had 3 years of steady global growth. We've expected a pickup in 2012, 13, 14. It never really picked up. Growth was always on the order of 2.5%. So that is now, it is increasingly reflected in commodity prices. So we expect actually, expect a very slow-moving recovery. And
you expect a recovery, but a slow recovery.
Very slow-moving, slower, about 0.4 percentage points less than we had expected originally in June. And we expect commodity prices to remain soft.
This is the general picture. What about the specific areas in the world? Are there differences, let's say, in Asia, in Africa?
Yes, so I mean, the main reason for our forecast revisions is the euro area and Japan, because they're large, they have a large weight in the global economy, and we have revised them, especially the euro area, substantially, because it seems to be struggling to just gain momentum. But actually, our forecast revisions are fairly broad spread. And that is currently also a reflection of the low oil prices. Many of the developing, or low commodity prices, many developing countries are commodity exporters. The one region which we expect to really benefit from low commodity prices is South Asia.
South Asia.
Yeah, it's not just because of low oil prices, which is already helping drive down inflation. It's also because they have the largest country in South Asia, India, is having a very reform-minded government. So there's a lot of enthusiasm, investor sentiment is very good towards India. So we expect strong growth there.
What about China?
China is interesting. It has two facets. So on the one hand, we expect growth to slow, and we have revised our growth forecast downwards because the authorities are really very carefully managing a deliberate slowdown. On the other hand, the slowdown is to 7%, which is still a very high growth rate among any countries, including developing
countries. It's less than
countries.
it was, of course, before. But
yeah. But interestingly, perhaps, we expect India to grow from about 5.6% to around 7% in 2016. So as China slows, China's growth rate falls towards, and India's rises, they're converging towards near 7%.
And what about Europe?
For Europe, we have been surprised on the downside. Even in core economies, investment has surprised us. We expected confidence to be strong. We expected investment to pick up. Consumption has been reasonably resilient. But we had to revise our forecasts significantly because it just seems to be struggling against the headwinds. High unemployment, financial sector fragmentation. In general, it didn't help that there were geopolitical tensions around Europe. So even if the direct effect is difficult to quantify, it certainly didn't help the investment climate or the investor confidence. All of these seem to be just headwinds that Europe is struggling to move
What
out
about
from.
internal issues, let's say? Do you identify any internal problems in the European Union that are holding back?
Well, there seem to be still structural rigidities, otherwise unemployment would not be so high and would not be so sluggish to respond really to fall as growth. Europe did emerge from recession last year, and yet unemployment is very high in large chunks of it. Okay, not in Germany, but in large chunks of it. So there are still a lot of structural rigidities that need to be addressed.
And do you believe that, of course, that at this moment many countries in member states in the European Union are undergoing adjustment programs? For example, Greece, Portugal. In these countries, we see that the situation is not going as it was projected, both economically and financially and politically. Now, do you believe there's something wrong in the mix of policies that is applied?
So specifically for those countries, we don't publish any detailed euro area forecasts. But clearly there is the uncertainties surrounding political environment, but in general, even about growth prospects in the euro area as a whole and the risks around, for the area-wide stagnation, do not help investor confidence, including in the periphery.
And, well, you are mainly focusing in developing countries. The European Union is not a developing area, it's a developed area. Even the countries that are facing problems are developed countries compared to others. But all countries here are dependent from energy. This is both an economic problem and a political problem for Europe. You know the situation that has arisen with Russia, with the energy issue. Now, do you believe that this oil price decline influences European Union's prospects?
Yes,
directly?
we do actually. So granted, we have revised our growth forecast down substantially, but we would have revised it down more if it hadn't been for the oil price effect. We do expect Europe is energy dependent, and it does import a lot of oil. So we do expect this to support consumption growth and investment.
But this oil price decline is rather recent. It's not...
yeah, and it'll take a little while to take effect. But perhaps a really important effect, in addition to the effect on growth and activity, it'll help, but then there is generally this environment of weak demand that overwhelms a bit the effect of the low oil price on activity. But there's also the effect on inflation. So globally, we expect that these low oil prices reduce global inflation by anywhere between 0.4 and 0.9%. And in most countries, that is actually helping central banks.
Yes.
Because for Turkey, for example, or in India, it helps bring inflation towards or into target ranges. In the euro area, it's a bit different.
It's the opposite, I think.
Exactly, because
Yes.
there is the risk that inflation expectations become de-anchored. So a series, several months of negative inflation could increase the risks that inflation expectations become de-anchored, and then the challenge is for the central bank to make sure they don't.
But of course, in the European Central Bank is rather working with its hands one hand tied behind its back. Do you believe that it will be able to face the situation? What could one do? It's quantitative easing, perhaps, or what?
Yeah, I mean, to expand the balance sheet, we do think that further monetary easing is needed. And they have announced already that they will try to expand their balance sheet up to by $1 trillion, back to a 2012 level. The LTROs have been somewhat disappointing, so monetary easing, in our views, is necessary at this point. Yeah.
Yes. And let's return to the oil price decline. It's something that we're not used to. Why do you believe that the OPEC countries did not react to this, did not support the price of oil?
Yeah. So what you're saying is something we are not used to is actually very true. There have only been 5 episodes of this kind of oil price decline over the last 30 years. Oh. And they were usually associated with deep recessions. So with the 2008-9 recession, with the Asian crisis, or the US recessions. The only one that is a bit comparable to this current price decline, which is also, and it was also associated with a change in OPEC policy, was in 1986. And there also you had, for years, you had North American, the Mexican oil coming online, and then OPEC changed its stance, and then the oil price really declined in '86. So we see a bit the same thing happening here.
Why? But why did they choose to follow this policy this time? Are there political reasons, perhaps? Because the normal thing that we expect them to do is diminish production and support the price.
Yeah, I mean, there are many theories about why they did. It's very hard to tell unless you're inside it. But perhaps it's interesting to bear in mind that for the Gulf countries, many of the OPEC countries, but not all of them are the Gulf countries, they are actually a bit insulated from that decline because they have these large sovereign wealth funds. So they can buffer fairly low oil prices for an extended period of time before they have to start trying to make savings, either import compression or fiscal savings.
Does this fall in oil prices create problems for other kind of oil-producing countries or methods, like shale gas, like the development of new fields?
Yeah, shale gas is very interesting because it's quite different from the other forms of oil, especially conventional oil. It takes not much investment to extract shale gas, and these are very short-term projects, 2-3 years. So it's a very flexible way of providing oil. So even if they manage, if for any reason some of these shale gas producers were driven out of the market now, they could very quickly come back online.
Very easily, yes.
It takes $2 million, that's it. It takes 2 years, and 2 years it's extracted and they move on. So it's a supply that is very responsive to prices. That makes it an interesting experiment, and if actually some of them drop out, and their break-even point is supposed to be anywhere between 60 and 80, if some of them actually drop out now, they could very quickly come back on.
And of course it does influence, and of course this has also political repercussions. It influences other oil producers or gas energy producers like Russia, for example.
Yeah, we have seen the impact.
And do you expect the impact to be very serious for Russia, given the fact that prices for other commodities as well are falling, and the Russian economy is based on commodities? So these countries, several of them have come under pressure, not just Russia. No, Nigeria has come under pressure. Colombia's currencies and the CDS spreads have also come under pressure. So clearly, we've reduced our growth forecast also for the oil producers in general. For Russia specifically, we expect a recession, like many do at this point, on the order of about 3% contraction next year, and essentially stagnation the year after. So it's 2 years of very weak activity, if not contracting. But for Russia,
it's more than the oil, and it's more than the commodity prices that are driving, dampening activity. It's also the sanctions. It's the fact that a lot of corporates have lost access. Most corporates at this point have lost access to international capital markets. The central bank has hiked interest rates, so borrowing costs domestically have been driven up dramatically. So all these things are going to weigh on investment. And then there, of course, is the oil effect.
So now let's broaden it to the whole, let's say, to the international economy. Now, do you believe that, what are your predictions actually for world growth and, of course, employment worldwide during the next couple of years, as you mentioned?
Yeah, the last 3 years have been disappointing. Every year we've had to revise our forecast down, and it's been essentially flat around 2.5%. We do expect a pickup, but only from 2.6% in 2014 to about 3% this year, 2015, and then 3.25% next year. Yeah, and there's really 3 drivers, in our view, to this global outlook. There's soft commodity prices, which on aggregate are going to support growth, but they're going to lead to large income shifts from the oil exporters to the importers. Second, we expect, despite the first policy rate hike in the US, we expect financing conditions to really stay quite accommodative throughout this year, and perhaps into 2016. So really that will help growth in developing countries. It will help support capital flows also. So even if they moderate, they will remain strong. The third major force driving the global economy is actually detracting or holding back growth. Because ever since the crisis, global trade has been fairly weak, not just because of weak demand, because also some structural changes. So that is going to be a headwind to global growth, in our view.
Of course, global growth is one thing, employment something different. Do we expect growth with employment or growth without employment, as we have seen many times recently?
We expect some of this to trickle through, and especially in the US, the labor market seems to be really improving. In the UK also, it seems to be fairly robust. So we expect some trickle through into employment. But that usually, it takes some time for growth to feed into employment, and that loop from growth to employment and back to growth takes some time.
Ms. Ohnsorge, thank you very much for being with us.
Thank you very much for inviting me.
Thank you for being with us at New Europe Studios.